Something serious is happening in the silver market. China has already begun quietly shutting down its silver exports. The real question is, what will happen when the world discovers that most of the silver on the market isn't actually there? Welcome to Economy Summaries. Let's get started. The market is strangely quiet today. There's no sharp movement in gold, no explosion in silver, despite all the news circulating. The first reason is the liquidity freeze on Monday, when major U.S. banks and Wall Street funds were completely closed for Memorial Day. The lack of U.S. liquidity led traders in Asia and London to refrain from opening large positions or making big bets before Wall Street opened. The second reason is the temporary political calm in the Strait of Hormuz, which has temporarily eased the panic in the energy and metals markets. This is why we've seen a cautious stabilization. Silver is near $75.50, and gold is around $4,508. But this calm may not last long. Over the past few days, headlines have been circulating claiming that China has halted silver exports. But the reality is more complex. China hasn't completely banned exports, but it has imposed strict restrictions, allowing exports only through specific, officially approved companies. More importantly, this decision isn't entirely new. It has been gradually implemented since the beginning of 2026. The real reason behind this policy is that China has been facing a persistent problem for years. Global demand for silver has exceeded production capacity for the sixth consecutive year. In other words, the world consumes more silver than it produces. To understand the seriousness of the situation, we must understand the difference between the Shanghai market and Western markets. On the Shanghai exchange, when someone buys silver, they must pay the full price and receive the physical metal within days. In America and Europe, however, the situation is completely different. There, paper futures contracts based on leverage are traded. Shockingly, more than 95% of these contracts don't result in the delivery of physical silver. They are settled solely in cash, in US dollars. This means that a huge amount of paper silver is traded without the metal actually being held in vaults. This is where the true impact of the Chinese decision becomes apparent. Any strong buying spree or sudden geopolitical escalation could reveal that the actual supply of silver is far less than the market believes. If China continues to restrict exports, and with the global production deficit persisting, Western markets could face a genuine shortage of physical silver. This partially explains the widening price gap between metals in the East and West. In this scenario, any sudden surge in demand for physical silver could rapidly push prices towards $85, then $92 per ounce. This isn't solely due to speculation, but also to the inherent shortage of the physical metal itself. All eyes are now on the opening of Wall Street on Tuesday. The market is expected to attempt to push silver through the nearby resistance level of $76.10. If silver manages to stabilize above this level with the return of U.S. liquidity, we could see a rapid surge towards $77.20, then $78.50. But this hinges on one crucial condition. Prices must remain above $74.80, because any clear break of this level could open the door to a temporary corrective pullback towards $73 before resuming its upward trend. As for gold, it is expected to experience significant volatility in the early hours of trading. The market will attempt to maintain the important psychological level of $4,500. If gold manages to hold above it, we might see an attempt to rise towards $4,535, then $4,550. However, if a clear break below $4,493 occurs, technical selling algorithms may kick in, potentially pushing gold towards the $4,450 level. Ultimately, everything we have reviewed today is a technical analysis based on current data. But markets are no longer driven solely by numbers. They are also driven by fear, politics, and surprises lurking behind the scenes. If any sudden escalation occurs, all technical resistance lines could disappear within hours, and the physical metal itself would become the only true arbiter of the market. Thank you for watching. If you enjoyed this type of in-depth analysis, please subscribe, turn on notifications, and like the video. Stay well.